Welcome to our video presentation on the recent increase in capital requirements proposed by the Reserve Bank of New Zealand. In this presentation, we will outline the positive and negative impacts and why we support the proposal. Capital requirements set the amount of capital a financial institution must hold, as a percentage of risk-weighted assets. It allows banks to remain liquid enough to service depositors even when sustaining losses due to market or operational risk. The Basel Accords dictate the principles, but specific requirements of a country are set by the regulatory body of the country.
Better coverage of liabilities with capital reserves, especially in a crisis, allows banks to stay liquid and service deposit withdrawals. Inability to service withdrawals indicates to creditors that a bank is in trouble. This may result in a bank run. If banks become insolvent, the additional capital buffer will allow creditors to recover more of their deposits than they would have been able to at a lower percentage requirement. This is especially important given that there is no deposit insurance in New Zealand.
Increasing capital requirements will also have the effect of reducing moral hazards. One reason is the increase will more closely align bank incentives with depositor welfare. There is a moral hazard between banks and depositors, as banks are risking deposit money that is not as important to them, demotivating the monitoring of borrowers. Diamond argues that with higher requirements, banks will be more active in their role as the delegated monitor of their loans, as higher capital requirements cause shareholders to experience a greater proportion of profits and losses. According to Carlson, the increased liquidity from the requirements also decreases the chances of requiring aid from the central bank, the lender of last resort. This decreases the chance of reliance on the central bank as a safety net, which is a source of moral hazard.
A 2010 study by the Basel Committee on Banking Supervision showed that the greater the proportion of tangible common equity relative to risk-weighted assets corresponded to a decrease in the probability of a systematic banking crisis occurring. The relationship between a greater proportion of common equity and the risk of a crisis is illustrated on the slide. It shows that the increased requirements at worst result in a 4 times smaller chance of having a banking crisis. Bank profits and bank values will be affected by the proposal. The Reserve Bank of New Zealand and the Big Four Australian banks are in agreement that the effect will be about a 70% decrease in profits over the next 5 years it will take to accumulate the additional buffer. These decreased profits will certainly lower the value of banks in the short term, but a better question is whether this will extend into the long term. A higher proportion of equity to debt will increase the bank's cost of capital, particularly due to the tax shielding nature of debt financing. The result under a discounted cash flow model suggests banks' values will be lower due to the discounting effect of the cost of capital. While the cost of capital may have a value-lowering effect, some researchers like Berger have shown that the increased market discipline and monitoring that banks partake in can result in return on equity increases, which likely result in an increase of bank value. However, it is unlikely that this effect would outweigh the change in the cost of capital. It is also worth considering that the Big Four are amongst the most profitable companies in New Zealand and in the past decade alone have experienced a 75% growth in profits. While the banks are important in the functioning of New Zealand's economy, much of this profit is taken overseas given the nature of their subsidiary structure. So, as long as they continue to operate efficiently, small but long-term profit decreases, if any exist, should not have any major effects on social welfare.
Due to the increased bank costs associated with higher equity, banks will aim to absorb as much of these costs as possible. Part of this will be realized in the form of a wider margin between deposit and loan rates. Westpac speculates that increased lending rates would mean fewer people borrowing, therefore lowering the bank's demand for deposits and in turn decreasing the interest rate offered to depositors. The higher margin will increase loan rates, which reduces monetary supply. It is well understood that this is the effect of decreasing economic growth, which can have run-on effects including higher unemployment and lower social welfare.
We have seen that the RBNZ proposal will have a positive effect on bank safety in the New Zealand banking environment. This is supported by a number of credible studies, including from the Basel Committee. The trade-off is a decrease in bank profits, bank value, and an increase in interest rates. Given that the major banks are among the most profitable companies in New Zealand, and given our lack of deposit insurance, we feel the trade-off of that is worth making. As a result, we support the RBNZ proposal.